Passive income is the idea that you can make money without doing any work, and that whole concept is kind of true, but it's also kind of a lie. There's no true way to create an income that will pay you forever without you having to do anything. There are three general ways that I generate cash flow, and some of these are way more passive than others. They are PRR, purr, kind of like a kitty cat. Profits, rents, and royalties. Let me start by talking about the P, the profits, because there's two ways that I generate cash flow from profits. One is through my own businesses, this is much more active, and one is through public companies. This is much more passive. My own companies each has their own monetization strategy, and each one of these, when they have a profit at the end of the year, because I own the companies, I control the profit. Now I get to choose how much of this money I want to reinvest back into the company and how much money I want to take out for myself. Now, in order for me to generate this type of profit, I have to work in the companies because right now I am the CEO of both companies. So I come up with ideas of how do we grow the company, how do we manage the team, how do we increase revenues, how do we increase profits, and where do we invest our money. All these things are things that I'm working on, things that I'm operating, and things that I'm constantly spending time on. So these are active investments for me because I have put my own money into these companies, I have put my own time into these companies, and these are companies that I'm actively working to grow. On the public and much more passive side, I invest some of my money into the stock market, and I invest my money in the stock market in two ways. I have an active investment and a passive investment strategy. My active investment strategy is where I look for companies that I like, that I believe are undervalued, and when I find a good company, I'm going to come in and buy. On the passive side, I have a system where every Wednesday, I have cash that automatically leaves my checking account and is invested into my portfolio of different ETFs. That's completely passive. And in this ETF portfolio, the largest chunk of that is a dividend pie, a dividend slice of ETFs where I have multiple different dividend paying ETFs, high dividend paying ETFs that I invest my money into. So every Wednesday, I have cash that leaves my checking account that is invested into a portfolio of different ETFs, but the ETFs that get the most cash every Wednesday are my high dividend paying ETFs because cash flow is king. Let me break down what this means from the simplest aspect, which is you have some companies that trade on the stock market. When a company trades on the stock market, they become a publicly traded company, and anybody, you, me, anybody else can buy shares of these companies. And when you buy a share of this company, you can make money one of two ways. You can make money when the stock price goes up because now this company is more valuable, or second, you can make money when this company has a whole bunch of cash in their bank account and they give it away to the shareholders, people like you and me, in the form of dividends. Dividends are regular cash payouts that companies pay out to their shareholders, typically every quarter, meaning every 3 months, and this is cash that you get without having to sell your stock, and you don't have to do anything. You just get this cash deposited into your investment brokerage account. So if you invest in a company that's paying a dividend, because not all companies pay a dividend, well, if you own that company, well, now you're going to get a check or you're going to get cash deposited into your bank account for doing nothing except owning the stock. The reason why I don't say it's completely passive, although it is very passive, is because you still have to research the company. You still have to make sure that this company is not on the verge of bankruptcy. You still have to make sure that this is a good investment, because you don't just want to buy a company or a stock or an ETF because it pays out a dividend. You want to make sure that the underlying investment, the underlying asset, the company, is a good company. So it requires some research and work on your part, because you don't want to invest your money into this thing that pays you dividends for 2 years and then your investment goes to zero. So you want to make sure that not only are you getting your cash flow, but you own a good investment that's hopefully going up in value. That's where the research and time comes into play. Now, instead of investing into individual companies, you can also invest into ETFs. ETFs are funds that give you exposure to a lot of companies. And there are some ETFs out there that have the sole purpose of investing into high dividend paying companies. That way now you kind of diversify your investments into high dividend paying companies because you invest into one fund, one ETF, and this gives you exposure to dozens or hundreds of different high dividend paying companies. That's what I do. Now, I do have some companies that I invest in individually that also pay me dividends, but what's much more passive is when I invest into these ETFs, because now every Wednesday I'm buying more of these dividend paying ETFs because I want to build that cash flow, because cash flow is king. I like that type of cash flow because I want to be able to live my life not based off of how much work I'm doing, not based off of what my salary is for my jobs, but based off of the cash flow that I can get that's coming in pretty passively, because I can manage these with much less effort, with much less time than me actually running my companies. So I like cash flow. That's how I invest my money, and you're gonna see that throughout this video. But when it comes to dividends, this is when you invest in companies that are paying out a cash flow dividend. Now, there are other investments that you can make, like I invest my money into non-cash flow producing companies as well, but that's a smaller piece of my stock market portfolio. I also invest in startups, but these startup investments that I make don't pay out any cash flow. And so when a company's paying out cash flow, when a company's paying out dividends, they have a completely different game plan and a completely different investment. And you got to understand what makes sense in your portfolio for your position. Because if a company has enough cash to pay out a dividend, what that means is they're taking this cash and instead of investing it back into the company, to grow the company bigger, to make it into a larger company, to grow faster, they're taking this cash, pulling it out of the company, and they're giving it to the shareholders, the investors. So this company is pretty large, and you're not going to see this company grow as fast as they could if they invested this money back into the company. So you have to kind of pick that balance. What do you want? Do you want a company that's growing faster in price, or do you want a company that's paying you cash flow? For me, I like cash flow. I do have some companies that I invest in for more of the growth side, but a larger piece of my portfolio is for cash flow because cash flow is king. You're going to be saying that with me by the end of this video. So I like cash flow, which is why the biggest chunk of my investments are cash flow producing investments. Now in the stock market, I do have a piece of my investments that are going into more speculative, more innovative side of things. This is more risky, where it's more on the side of growth, but that's a smaller piece of my portfolio. Just like when I invest in startups, startups many times don't have a profit. They don't have any cash to pay out dividends. What they're doing is they're trying to grow as quick as possible, as fast as possible. I invest in startups, but when I invest in a startup, I'm not looking for cash flow. I'm looking for growth. Again, I invest in startups, but I have more of a dividend cash flow producing portfolio than I do a startup portfolio. So understanding where it is that you want to invest and understanding what type of portfolio you want and what type of growth you want. I like investing in startups. I like investing in innovation. For me, that's fun, but that's more of a speculative part of my portfolio than it is the bulk value side of my portfolio. The reason why so many people get discouraged when they look at investing their money for this type of cash flow is because they run the numbers and then they get very discouraged. They say, if I can find an investment that's paying me, say, a 4% annual dividend yield, it's going to cost me $150,000 today to get this 4% return, which is going to pay me $500 a month or $6,000 a year. I don't have $150,000, so it's not even worth it for me to start. But what you're missing is you don't have to invest all $150,000 today. If you create a passive investing system, you could invest $100 a week, $50 a week, $10 a week. And what you're doing now is you're starting the cash flow system. And you have to start somewhere. You got to start with $10, $1, $200, $2,000. It doesn't matter. Everybody has to start somewhere. And now you start. And you keep investing every time you get paid. Ideally, every week. You want to be investing as often as possible. And no matter what, you always want to have some cash to put aside. And if you do this, not for 6 months, but if you do this for years, every 12 months, you're going to look back and you're going to see the progress that you made. And now, every year, you're going to be getting bigger cash flow statements. Because now what you're doing is you're putting more money in. Every time you buy more of this investment, you're going to get more cash flow out. It's buying a machine that pays you with cash. The more you buy, the more cash flow you get. So each year, you're getting more cash flow. And on top of that, if you want to get even more aggressive, you can automatically reinvest the cash flow that you're getting. You can reinvest the dividends. So not only are you working to invest more money, but now every time you get paid, you can buy more of this machine that's paying you with cash flow. It's like a whole cycle where you just keep buying more of the cash flow and using your cash flow to buy more cash flow until you're ready to ultimately use the cash flow, because cash flow is king. So this is where you want to understand that you don't need to put in all $150,000 right now to make it worthwhile. Start with $100, start with $1,000, start with $10,000, start wherever you are. Just consistently keep investing your money. That way you can build up your cash flow portfolio. But if you have access to more cash, the second place where you can generate this type of cash flow, if you want to do it outside of your own business, is to do it through rents. The way rental cash flow works is you're going to go out and invest in some real estate. You're going to own a property, a house, an apartment complex, an office. You're going to own some sort of building, and then this building you're going to rent out to somebody else. Somebody's going to live there, or a business who's going to use your property. And in exchange for this person or business or thing using your property, they're going to pay you rent. And if you do it correctly, this rent is going to cover all of your expenses and put some money in your pocket every single month. And if you know how to do it the right way, well, it can be completely passive on your end after you buy the property and after you build the right team. I have other videos on my channel where I go over how to actually invest your money in real estate. So if you want to learn more about that, you can check out those videos. But the key here now in terms of rent is how active do you have to be? It's not as passive as investing your money into dividend-paying stocks, and it's not as active as building your own business. So where in the middle is it? Well, if you're just starting off, it's going to be more on the active side because you're going to have to go through all the hurdles and hoops to learn how to invest in real estate. But once you build the right team, once you have the experience, well, then it's going to fall much more on the passive side. When I invest in real estate, it's much more passive for me because once I find the property, I know exactly who I have to call, who I have to text, and then I pass on the duties onto them, and everybody knows what to do. And then I just walk away and I let my team do its thing, and I let my property manager handle the entire process. Now, when it comes to cash flow, there's two things that you have to understand. First thing I want to say is there is a lot of different ways now for you to get exposure to real estate investments without actually investing your money in real estate. The old way to do this was to invest your money into a real estate syndicate deal. The way that worked was if you go to any real estate investor meeting, they happen around the country, there's always people there, always, who are looking for cash. They're looking for investors that way can raise money, that way they can go on and buy a property. The way it would work is like this. Let's assume that this is an apartment complex and it costs, I don't know, $5 million. If it costs $5 million, this investor is going to need $1 million of cash to raise the debt to buy this property. So they're going to borrow $4 million and get $1 million worth of cash. If they don't have $1 million worth of cash themselves, they're going to have to raise this cash from other people. Maybe they have $100,000 themselves and they have to raise the other $900,000 from investors. Well, if you go to these real estate meetings, there's always people who are trying to raise this $900,000. And you could be one of the people who invest maybe $10,000, $100,000 or more that you invest into this, where now you own a piece of equity, and then they're going to work to buy the property, renovate it, and get it rented out, and then pay you maybe with cash flow, or they pay you when they sell the property or refinance. They might have a deal that says you invest $100,000 and then I'm going to pay you a 15% return over the next 3 years. It just depends on the deal, depends on the investor. Everybody is different. But this was the original passive way for somebody to invest in real estate without actually investing in real estate. It's a way for you to get exposure to a deal without actually being a part of the deal, because now you're passive. You're letting the investor, the developer, do all the work. You're just giving them the cash. Now, thanks to technology, there's a lot of different crowdfunding sites that allow you to do something similar without actually getting exposure to the deal. So if that's something that you're interested in, you can look at some of the crowdfunding sites out there to see if there's something that you like. Now, when it comes to you actually owning the property, now you are the developer, you own the building, you own the property, and now the cash flow is going into your pocket. The reason why wealthy people love investing in real estate, this was something that I had to learn through reading books because nobody ever told me this before. I wish we would have learned this stuff in school, but the reason why wealthy people love owning real estate is because wealthy people have a lot of money. Now, when you have a lot of money, where are you going to keep it? You can keep it in the bank, but the bank is only FDIC insured up to $250,000. Now, you don't need $250,000 or more to do this. You can do this with a lot less, but I'm telling you what wealthy people think. They have more than $250,000, so they don't want to keep it in the bank because now this money is at risk of potentially losing if something happened to the bank. Second, your bank isn't paying that much interest. And third, your bank is losing value to inflation. So now what wealthy people do is they take this cash and they want to move it somewhere safe. Well, what's a safe place to leave it? Well, you could put it in the stock market, but we all know the stock market is very volatile. You can see the price of the stock market get cut in half in a day. I mean, we've seen crazy things happen in the stock market. And so wealthy people want to own something tangible, something that holds its value a little bit better. Now, does this mean that real estate never goes down in value? No. We saw the 2008 crash happen where real estate prices were slashed into a fraction of what they were before, However, you don't see the same volatility in real estate the same way you do in the stock market because you can't buy and sell a property the way you can buy and sell a stock. So real estate holds its value better, but that doesn't mean it only goes up in price. Real estate does go up and down. However, you don't see the same fluctuations. So number one, it allows you to own a tangible piece of property. Second, some people use real estate as a way to buy more because they can use debt to buy more real estate. And third, you get tax breaks from your real estate because now real estate offers some of the biggest and best tax breaks that our tax code has to offer. And then fourth, on top of that, while you own the property, you're also getting paid with cash flow. And if you do it right, this cash flow is going to be way more than the interest you would get from the bank. This is why wealthy people love investing in real estate. Now, the nice thing is you don't need a ton of cash. You don't need millions of dollars to start investing in real estate. You do need some cash. If you don't have $50,000 saved up, it's going to be very hard for you to start investing in real estate unless you are involved in these type of syndication deals, or unless you are a developer, you're a hustler, you're a salesperson, and you can go out and get the cash to invest in these properties. If you just want to invest in real estate and you don't have access to $50,000 worth of cash, it's going to be very hard for you to actually go out and buy a property. Real estate is my largest investment outside of my own businesses. The reason why I like real estate is because of the cash flow, because when I go out and I buy a property, I know that I can create cash flow from this property. If I spend $100,000 on a property, my goal is 7% cash on cash return. Meaning for every dollar that I invest, 7 cents come back into my pocket every single year as profit. If I invest $100,000, that's $7,000 a year in positive cash flow. So my goal, especially when I started investing in real estate, was anytime I made money, was I took this cash and I bought a property. I made cash and I bought a property. I made some money, I bought a property. That was it. I wasn't spending any money on myself. The only thing that I was buying was real estate because I knew that the real estate would pay me with cash flow and I could spend that cash flow and not have to worry too much because I knew the cash flow was going to come back next month. That's the value with real estate. It takes a lot of sacrifice because that means you're going to have to make big sacrifices with your money. You're going to have to take big chunks of cash and take it to go out and buy a property. However, if you can stay consistent with that over the course of years, over the course of a decade, you can build a lot of cash flow. And what a lot of people like to do in the real estate investor community is they make a goal of just buying one property a year, one home a year. If you can buy one property a year, you can save up to do that. Well, each year, you're going to be adding on more and more cash flow. And every year, it's going to become a little bit easier for you to buy another property because you can save up the cash flow that you're making from one property and use it to buy a second one. Use the 2 to help you buy a third one. Use the 3 to help you buy a fourth one. So it's all about stacking cash flow. You want to make money, use it to buy real estate, and then use the real estate cash flow to help you buy another property. It's like the game of Monopoly. You just keep working over time to buy more of that cash flow. Now, if you're struggling to be able to buy that first property, then maybe you have an income problem. Maybe you have a spending problem. And the income problem can be fixed by making more money. How do you make more money? Well, that's a topic for a different video, but you look at creating a side hustle, look at creating a side business, look at creating your own business, look for ways to create your own income. You don't have to be a salesperson to do this. I'm not a very good salesperson, but there are many ways for you to produce more value. If you like the idea of being an entrepreneur, of how you can create more income. There are so many different ways out there, and the internet has made it so much more accessible, not easier, but more accessible so anybody can start creating more income. And then it's, what do you do with that income? Do you buy a bigger car? Do you go on another vacation? Do you go to nicer restaurants? Or do you go out and buy real estate? For 10 years of my life, I spent no money at all on myself. I drove a beat down car. I didn't eat at restaurants. I didn't go on vacations. I wasn't going out with my friends. I wasn't spending money so I could do one thing: buy real estate and create rentable income. That was what I worked on for a long time, and I made a lot of sacrifices for that. Now I spend a lot more money, but I have the ability to do that because not only do I make more money from my businesses, but I also have my cash flow from my real estate. I have cash flow from my dividends, and I still have a system where every year I'm working to create more cash flow through real estate properties, through my dividends, because cash flow is king. The third way that you can generate cash flow is through royalties. And again, this can be somewhere between active and passive depending on how you build it. And there's 2 ways to generate these types of royalties. One is through physical products, one is through digital products. Before I was on YouTube, I was in the sock industry. I used to have a sock company where I created this water-resistant athletic sock, and I would sell this online. Now, unlike most people who sell products online, my goal wasn't to build a sock company. My goal was to license the technology that I had. So I worked with sock manufacturers, I worked with textile engineers, and I worked with a whole bunch of other different types of engineers when it comes to apparel engineers to create this water-resistant technology to build a sock that was water-resistant. And that's what I did. The technology already existed, but it was never used in socks until I came around. And so I used this technology to make these water-resistant socks, and we had a great company. But my goal by selling it online wasn't to build a sock company. It was to have a proof of concept that way I could then take this technology and license it to the other major sock manufacturers and other retail companies out there. The problem was I didn't create this technology. I created a new use for this technology because I was the first to find a way to put it into socks, but it wasn't enough for me to get approved for a patent. So all the licensing deals that I had pending all fell through when I didn't get the patent, because none of these companies had to pay me a royalty fee to use my technology because they could just bypass me and do it themselves. So it didn't work, which is why I shut that company down, along with me seeing success in other places. However, if it did work, that would be an example of a physical royalty. Many times people think of you building a business as a royalty, but that's not really royalties, because you have to build the business and then what you get is profits. I talked about that earlier in this video, where profits are different than royalties. It's different ways to generate cash flow, but royalties are now where you create something and then you get paid for the thing that you created for years into the future because of that one thing that you created. So one way to do this is through royalties. Another example of a physical version of these types of royalties will be writing a book. Authors who write a book, if you can get it into stores, if you can get it onto Amazon, if you can get it into places where people keep selling and buying your book, well, now you create royalties where now every month or every quarter, every year, you're going to get a check from your publisher because of all the sales that your book is bringing in. Now, I don't have experience with this. I have never written a book before. I don't have a book, but I know people who are authors who make a decent amount of money through royalties from the books. I hear it's not a ton of money, but a decent amount of money, unless you can sell a ton of books. But if you can build a book and people are buying it and publishers are pushing it, well, now you can start getting royalties from the books that you're selling. On the digital side, most of this has to do with content. This is ebooks that you create and you sell online as opposed to a physical book. This could be YouTube videos that are still generating ad dollars years after you produce the video. This could be blog posts that are generating traffic, that are making you affiliate money or sponsorship money. And this could be podcasts that people listen to years after you publish it that are still generating you advertising dollars. Now, as somebody who is on YouTube, I can tell you from experience that yeah, you can make good money through advertising dollars. However, the way that it works in the content game is there are a lot of people that are trying to create more content. So unless you keep creating more content and unless you keep creating good content, your old content stops getting views and your old content stops driving revenue. So the whole idea, people think, is if you make a video now and this video goes viral, you're going to get paid for that video for years into the future. But the reality is if you want to keep getting paid for that video that you made years ago, you have to keep producing good videos today. So it's kind of a pseudo passive income in the sense that, yeah, you can still generate revenue from old content, but in order for the old content to keep generating you new revenue, you have to keep producing good new content. When it comes to this type of cash flow, the general consensus is there's two different ways to create cash flow. One is you can buy it. The second is if you can build it. If you have money, but you don't have time, then you could go out and buy the cash flow. We talked about some of the passive ways. You can do it through dividend investing in the stock market. You could pick your own strategy there. You could do it through real estate. Creating royalties is going to be a lot harder for you to do much more passively. But if you have cash, you can go out and create this type of cash flow by buying the cash flow. If you have time, but no money, then the next thing is you can build the cash flow. You can build your own business. You can build something that pays you with royalties. That is now something you build with your time, and if you do it the right way, it can pay you with cash flow. Now, are you going to succeed? No, everything has risks, but what you're trying to do is you're trying to build something that pays you with cash flow, because cash flow is king, and if you want to be able to live your life financially free, you need to have cash flow coming in that allows you to live your life. And the issue that a lot of people have is they work to build more of a sporadic cash flow. And then they start living this very nice lifestyle. You see a lot of salespeople do this. I am a licensed real estate salesperson. I've worked with a lot of salespeople. And this is one of the biggest problems with salespeople. You go through these big months or these big years. The economy is booming and you make a ton of money, and now you start driving a nice car, you start wearing expensive clothes, you start going to nice restaurants and go to these expensive vacations, and then a couple years later, the economy takes a turn. Now that cash flow starts to go away. And now you don't have the same ability to live the same lifestyle, and many people don't want to give up that lifestyle, so now start going into debt to keep funding the lifestyle, and then you run into a whole bunch of other issues. This happens all the time, especially with salespeople, because that cash flow isn't consistent. The goal with the things that I talked about is to create a consistent cash flow, that even if things go wrong, you will still get some cash flow. Maybe you have to cut your rents, maybe some of your dividends go down, but you still have cash flow coming in that way you can continue living your life. Because if you can live your life based off of the cash flows that I just talked about and showed you, now you can live a much more sustainable life and a much more financially free life, because you can keep doing your thing while the cash flow keeps coming in. So this is where you have to be smart financially and understand how to use your money the right way. That way you can generate enough cash flow to live your life the way you want. And if you do it correctly, then you can spend all your money and get more cash flow next month. For most people, investing means give your money to Wall Street and leave it there for 40 years. That way when you retire, you hopefully will have a lot of money. The problem with this type of investing is you're taking on all the risk while somebody else is getting paid. Like, what happens if you're getting close to your retirement age and then a recession hits? Then what? We saw this happen before the 2008 crash. We saw this again in the 2020 crash, where the market crashed and people were selling out of their retirement accounts at huge losses. But what if you could get paid while you wait for your investments to grow in value? That's exactly what you get when you invest your money into cash flow producing assets. I like cash flow because when you have cash flow coming in from your assets, now you're getting paid without you having to go to work. And if you have enough income from your assets, from your investments to cover your expenses, now you're financially free. Your investments will pay you even when you're not going to work, so now you can live your life without having to worry about money because your assets are paying you with cash flow. Now this is going to require you to change your investment strategy a little bit to start generating this cash flow, but it changes the way you think, because now you're working to stack your cash flow instead of just working to stack assets that will hopefully be worth a whole lot more money at some time in the future. There are three general ways that you can invest your money for cash flow. Number one is through stocks and paper assets. Number two is through real estate. And number three is through a business. Now, each one of these have their own subcategories as well. Like in the stock market, you can get cash flow from dividend-paying stocks, or dividend-paying ETFs, or REIT stocks, or REIT ETFs, or international dividend-paying stocks. In real estate, it's the same thing. You can own and operate your own real estate. You can invest in real estate funds. Both of those will pay you with cash flow. And even in business, you can own a business that pays you profits. You can get royalties. So we're going to be going deep into all of these different types of cash flow in this video, which is why you definitely want to watch this video until the end. The nice thing about investing for cash flow in the stock market is, for one, you don't need a lot of money to start. You can start doing this with as little as $100, even less than $100. And second, you can create automatic investments, where now anytime you get paid, you can have some of your money automatically invested into your portfolio of cash flow producing investments in the stock market. And third, now when you start generating this cash flow from the stock market, you can choose if you want to automatically reinvest it to buy you more cash flow, or if you want to start using that money to start living your life. So you have a lot of flexibility with the stock market. So let me start by talking about the difference between dividend stocks and dividend ETFs, and let me go over some examples before we go even deeper. All the examples that I'm about to go over are just examples. I'm not telling you what to invest in, and investing has risks. You're never guaranteed to make money when you invest. You might even lose money, which is why you need to always do your own due diligence and never blindly trust a random guy on YouTube. When you invest in a dividend-paying stock, this means you are investing in an individual company. You're investing in a business. Now, this has its pros and cons, because if you invest in a good business that then takes over the world, well, now not only will you see the stock price go up, meaning your investment value rise, but you will probably also see your dividends rise as well, because when the company makes more profits and the stock prices go up, they want to keep compensating their investors, their shareholders, people like you, with bigger dividend checks. So you get bigger dividend checks just for holding a good company that is now growing. But you also take on the risk. Because now if this company goes down and they go bankrupt because the CEO ran the company into the ground, well, now not only are you going to see your dividends go down to zero, but the company investment value also goes down to zero. So you're taking on the highest risk, but you also have the highest potential reward. So a few examples of dividend-paying stocks that people like to look at are AT&T, JP Morgan, and Pfizer. These are three different ticker symbols. If you invest into the AT&T stock at the time we're recording this video, they are paying a 5.4% dividend yield. That means if you were to invest $100 into this company in 1 year, they would pay you $5.40 over the course of the year in cash flow. Now that might not sound like a lot of money, but you have to remember a couple things. Number one, this is cash that you're earning without having to sell the stock, without having to do anything. Maybe the stock price will rise as well, so now you have the appreciation in the stock price and the cash flow in your hand. And second, the way that cash flow investing works is you take the cash that you have right now that's not doing anything and you put it into this cash flow investment that then starts generating you a return. The more cash you have to invest, the more cash flow you will get. So the way you generate cash flow is by having more money to invest. We're not talking about how to get more money in this video. We're talking about how to take the money that you have and turn this cash that's not doing anything into a cash flow producing asset. The more stocks you buy, the more cash flow producing assets you buy, the more cash flow you will get in return. If your goal was to start generating $30,000 a year of cash flow, that means that you would have to invest $550,000 into this stock today at a 5.4% yield to get $30,000 worth of cash flow, and you'd have to invest just over $1 million into the JP Morgan stock at this 2.8% yield to generate $30,000 worth of cash flow today. Now you might hear that and say, wait, that is an impossible task. Where am I going to get all this money to start investing for cash flow? But this is where you have to also understand the goal. When you invest traditionally for retirement, you are investing for 40 years. You're putting some money aside every time you get paid, and for 40 years you're going to put money aside. That way you can hopefully have this big retirement nest. But this is kind of the same, but now instead of just working for a big retirement nest, what you're working to do is to also build cash flow as well. So this is something that you don't want to do just once. You want to keep investing your money every time you get paid, every week, every 2 weeks, every month. Keep putting some money aside. And if you keep doing this, yeah, maybe you start with $5 of cash flow right now, but you keep working to grow that year after year after year. And after a decade, you'll surprise yourself. After 2 decades, you'll be even more surprised. And then you'll start to see how you can start building even more cash flow to start living your life. Now, a big reason why this strategy doesn't work for so many people is because what company do you invest in? How do you know what's a good company? How do you analyze the company? How do you know if you're overpaying for a company? And this is a type of analysis that a lot of people don't want to do or aren't interested in doing. So if you're not interested in keeping up with a company, listening to its earnings calls, studying the financials, doing the valuations of a company, then maybe you shouldn't be investing in individual stocks, but you can consider investing in ETFs. An ETF is a group of stocks. It stands for Exchange Traded Fund. And now instead of investing in just the AT&T company or JP Morgan or Pfizer company, you can invest in all 3 of these companies and in 50 other high dividend paying stocks, because now you're investing into a fund that gives you exposure to dozens or hundreds, maybe even thousands of companies that are giving you a specific goal. Now, for the purposes of this video, we're talking about high dividend paying ETFs. So ETFs, funds that give you exposure to a group of high dividend paying companies with the goal of giving you a dividend. That way now, instead of you having to find the best dividend company to invest in, you can just invest in this fund. The advantage of this now is if you invest your money here into this AT&T company and then they go bankrupt, well, now you lose everything. But if you invest your money into a fund that gives you exposure to the AT&T company and 100 other stocks, well, now if AT&T went bankrupt, you have 99 other companies to balance this one out, and then the fund will automatically kick AT&T out and put another company in. So your risk is much lower, but your returns are also lower because now you're going to be balanced out by some of the losers. So you'll typically see a little bit lower yields here on the dividend ETFs, but your risk is significantly lower and your time investment is also a lot lower. A few examples of these types of dividend ETFs are SCHD, VYM, and SDY. When you invest in any one of these ETFs, you're getting exposure to a number of different high dividend paying companies. And as a disclaimer, I personally own SCHD and VYM. Now, how do you make a decision on what you want to invest in? For one, you want to make sure that the investment institution that's creating this fund is a reputable one. For example, Vanguard is the company that pioneered index funds, so they're very well known in this industry of funds. Second, you want to take a look at what are the actual assets within the fund. Like if we take a look at what stocks are in VYM, you can see this invests in companies like Johnson & Johnson, ExxonMobil, JP Morgan, Procter & Gamble, and hundreds of other companies because you have 440 pages of companies. So when you're you're looking for a high dividend ETF, you're investing in these without investing in individual companies. You're investing in groups of dividend paying stocks. Then we can move on to REIT stocks and REIT ETFs. A REIT is a real estate investment trust, and it's a way for you to get exposure to the real estate market. Now, personally, I prefer owning physical real estate as opposed to a REIT or a REIT ETF, just because I am a real estate investor and I like the idea of owning my own real estate. But when you invest in a REIT, now what you're doing is you're investing in a company that invests in real estate, and by law, these real estate companies are required to pay out 90% of the profits in the form of dividends, which is why many times you will see higher dividends on REIT stocks and REIT ETFs. Let's start by going over a couple examples of REIT stocks. But a couple examples of REIT stocks are O, which is Realty Income Corporation, and then SPG, which is Simon Property Group. These are two different real estate investment companies. This Realty Income Corporation, this is a company that invests in real estate across the country, even some international real estate now, and the Simon Property Group is one of the largest and most premier shopping mall owners in America. So now when you invest in these companies, again, you're getting exposure to the company, and then both of these companies pay out dividends. O pays out 4.41% at the time of recording. Simon Property Group is paying out 5.5% at the time of recording. Now, of course, there's risk when you invest in either one of these because now you're investing in the individual company, and of course, this is more reliant now on what's going on in the real estate market. If you really want to get exposure to REITs and you want to limit some of your risk, you can also look at investing in some REIT ETFs, something like VNQ or USRT. These are two different REIT ETFs that give you exposure to a basket of different REIT companies. That way you can lower some of your risk. And VNQ at the time of recording is paying 3.9%. USRT is paying around 3.4%. And then on top of that, you have your international funds, and we'll just focus on international ETFs, something like IDV or VYMI. As a disclaimer, I own both of these. Now, what these do is now you're getting exposure to companies overseas and around the world that are not necessarily reliant on the United States dollar or the United States government. Now, what does this mean? You're diversifying your way outside of the United States economy, outside of the United States dollar, into sometimes less stable countries, so higher risk, which is why you're looking for higher potential reward. That's why you'll see sometimes higher dividends on these, like IDV at the time of recording has just over a 7% yield, VYMI just under a 5% yield. So now it's a way for you to get exposure and diversification while still generating cash flow. Now, I'm going to shift gears now and talk about real estate investing, but before I do, I want to go over just very briefly on how I actually implement this, because there's a couple different ways that you can actually invest your money. You can take your money and go out and actively find an investment that you like and put your money in whenever you have enough money to invest. Or the second option is you can create a passive investment system. Like for me, with my ETFs, I have a passive investing system where every Wednesday, I don't have a secret science as to why I pick Wednesday, but for me, it's just Wednesdays. I have money that's automatically pulled out of my checkings account and is invested into my portfolio of different ETFs. Now, again, most of my ETFs are paying me with cash flow. Not all of them do, but most of them do. Now, what happens is every Wednesday, money is automatically going to be invested into this portfolio of ETFs that's now working to grow in value, but also grow in cash flow. And then when I get this cash flow is automatically reinvested to buy me more cash flow. The second way that you can invest your money for cash flow is by investing your money into real estate. And generally, when I talk about investing money into real estate, I'm talking about actually buying a property, whether it's a single family home, an apartment complex, an office building, something else, a mixed use building. You're buying something that way you can own it and then rent it out to somebody else. Somebody will use it or live there, and then they will pay you rent every single month. Now, there is an alternative, a passive type of investing into real estate where you invest your cash into a real estate fund and somebody else is going to operate and manage the real estate. So now you're a silent partner. You just give them your money. But generally speaking, if you want to invest in real estate, it's going to require more cash and more time up front. And it's also going to require a bigger team because now you actually have to operate the investment. When you go out and invest your money into a company, well, now the CEO and all the workers in the company are working to grow the value of the company. You just give them your money because now you want to see some of the profits, because you want to see your stock price go up, or you want to get your dividends. Well, when you invest in real estate, now you have to own and operate the property. Now, I don't recommend you manage the units yourself. I would say go out and get a property manager. That way now you have somebody who's making it passive for you. That way you don't have to be the one that gets the call that the toilet is clogged. Have a property manager that will deal with all the day-to-day issues, but you still have to find the property manager and manage the property manager to make sure that your deal is working and producing a profit for you. When I invest my money, I'm looking for a 7% cash on cash return on my money. That means for every dollar that I invest into real estate, I want to see 7 cents of cash flow from the property. So if I invest $100,000, I want $7,000 of profit hitting my bank account every single year. Now again, this doesn't accrue depreciation, but when I invest in real estate, I'm not investing betting that the property value is going to go up. I'm investing knowing how much cash flow that I can generate. Because for me, that bet on where home prices and real estate prices are going to go is speculation. It's gambling. I don't know what's going to happen with home prices in 6 months, 12 months, 18 months, 5 years, 10 years. So I don't like to bet on that. Instead, I want to look at this cash flow, because this is something that I can predict with much more accuracy. And if I can buy a property in a good area with growing demand where rent prices are strong, well, now if home prices go up, that's just icing on the cake. If home prices go down, well, at least I know that I'm still getting my cash flow. That's why for me, I am a cash flow investor, especially when it comes to real estate investing. Now, of course, real estate has some other benefits as well. You also get tax breaks. You also own a hard asset because now you own the bricks, you own the land, you own the windows, versus when you invest in a stock, it's just a paper asset. So there's a lot of advantages to investing in real estate, but again, it takes more time and more effort on your end. And the third way to generate cash flow is through business. Now, there's a couple ways that you can go about doing this. You can go out and buy a business, and sometimes this is going to require you to work there, but the profits that you get, not the salary you get from working there, not your hourly wage, but the profits that's left over in the bank account after you pay for all the expenses and your wage, that's the cash flow you get for owning a business. And second, it's by creating your own business or having something that can pay you with royalties or fees after you create something. Now, I've never gone out and bought a business that pays me with cash flow. I invest in startups, but these are not cash flow producing investments. These are investments that I'm investing in that I hope will get bought out or go public or get acquired, something like that. But I've never bought a franchise or one of the other businesses, so I can't really talk about that. However, I have created my own cash flow producing businesses. Now, there's a couple ways that you can go about doing this. Again, the first way is to create a business where then you can plug yourself out of, and then now you can have somebody there that will be working there, and you can get to share the profits. For example, I own a company called Briefs Media, and now with Briefs Media, I am the CEO of the company. So I get paid as the CEO. Now, when we have a profit in the bank account, meaning after we pay all the employees, we pay for the operational expenses, we pay for all the other expenses, all the remaining cash, that profit is what I get as the owner of the company. That's what gets distributed to the owners. Now, if I wanted to go leave and do something else and I wanted to bring in a new CEO, the CEO would take the CEO's salary, but I would continue to retain the ownership and the profits of the company because I own the company. So there's a difference between the money you make for working there and the money you get for owning the company. The second way you can get these types of business profits is a type of royalty. Back in the day, the most common way to do this would be either to create a technology and then license it out, or to write a book. That was the only type of content that you could really create where you could get royalties besides being an artist and making music and doing other things like that. But if you wrote a book and now you have a publisher selling it, it's at Barnes & Noble, it's on Amazon, every time you sell a book, you get a little bit of royalties. Well, now you also have the same type of royalty model with things like YouTube videos, with things like podcasts. So now I make videos on YouTube. When I make a video on YouTube and people watch it, I get paid. And I don't make a lot of money per view. Maybe it's like a penny per view. But when I make a video that's released a year ago and the video gets watched today, that video that was made a year ago is still producing revenue today. Again, maybe a penny per view, but this is now another way to generate cash flow from the business. Now, unlike some of the other investments, this is not completely passive, because even now with YouTube, if I want my videos from a year ago to continue getting views today, with the way the algorithm works, if I stopped putting out videos today, my videos from a year ago would stop getting views. So just the way that it works, you have to keep producing content today, that way old content can keep producing that type of revenue. But now the whole idea here is, can you create something? Can you build something? Can you own something where now you can go out and do something, and these profits are your cash flow beyond just the income that you would get for working there? This is what cash flow investing is all about, where now you're putting your money to work. That way now your money can get you money in your pocket today without having to wait to sell your investments at some point in the future. Because if you can build this type of cash flow, well, when you have enough cash flow to fund your expenses, Now you are financially free and you have broken out. Let's talk about investing for cash flow, because unfortunately there's a lot of, let's call it poo-poo information out there on the internet when it comes to the topic of cash flow investing, because a lot of people say, oh, if you want to get rich, just get this passive income, create this drop shipping site, start this Amazon store, create this ebook, and you're going to be making passive income, this cash flow. But the reality is, number one, that's not passive. And number two, it is so difficult to generate this type of cash flow. The way that real cash flow investing works for investors and helping people become extremely wealthy with cash flow is like this. I'm gonna draw you right here for my male followers. I'm gonna draw you a mustache, and for our female followers, I'm gonna draw you a braid. In my native language Punjabi, we call a mustache a much and a braid a gut. So now you go to work every single day at this job. Maybe this job is your business, and then this job is gonna pay you a salary. Now you're going to take a piece of the income that you did not spend at Gucci and Chipotle, and you're going to take this money and you're going to invest it into this asset. Now this asset could be something like a dividend paying stock. It could be something like real estate. I'll talk about how you can do this in just a minute, but now you're going to take this money, put it into this asset that's going to be generally passive on your end. Not completely passive, but generally passive. And now that you own this asset, it is going to pay you with cash flow. Maybe you get a check every month. Maybe you get a check every 3 months. Maybe you get a check once a year. Just depends what this asset is. And now you can take this money that you're generating and you can either buy more of these assets that are going to pay you with more cash flow, or you can take this money and use it to go out and buy you a brand new car. That's going to be your choice, but this is how real cash flow investing works. Now, the thing that you need to understand about cash flow investing that nobody wants to talk about on the internet is that you don't get rich by investing for cash flow. You got to be rich first to get a lot of the cash flow that will make you wealthy. The reason why is because you got to take the money that you're earning that you don't spend at Chipotle and Gucci, and then you take this money to buy these assets. So you need the money to generate the cash flow in the first place. And this is why it's so difficult, is because people hear this idea of generating passive income and cash flow, and it sounds very exciting. But the reality is, when you generate this cash flow, you're generating a return on the money that you invest. So let's assume, I'm going to be very generous here. Let's assume that you can get a 10% cash flow return. That's very high, by the way. But let's assume you can get a 10% cash flow return. That means if you invested $1,000 into this asset, you're going to generate $100 after 1 year of cash flow. $100 from $1,000 is not going to really pay you much. I mean, it's not going to fund really anything in your life. Even if you invested $100,000, then you're only generating $10,000 a year. Now, $10,000 a year is a lot, but it's not even $1,000 a month. It's not life-changing money for you to go out and start driving a Rolls Royce. You need the money to invest to generate the cash flow. This is where people say, but Jaspreet, if I need millions of dollars to generate a lot of cash flow, what's the point of me even doing that? Well, the point isn't for you to go and invest into this cash flow asset today and never do it again. The point is you go to work every single day. You get this paycheck every week, every 2 weeks, every month. Every time you get paid, you're going to take a little bit of this money and buy this asset. Now, when you do this week after week after week, month after month after month, year after year after year, decade after decade, now you're going to be building a solid stream of cash flow, especially if you're taking this cash flow that you're generating and using it to buy more assets, because now you're making money to buy cash flow, and the money that your money makes is buying you more cash flow as well. And now if you do this for long enough, now you're going to be able to build a solid stream. Now, the more money you invest into this asset, the more cash flow you're going to be able to generate. And this is why I call it the decade of sacrifice. Because if you put in a decade of time where you're working to live smaller so you have more money here, and then you take this money and you use it to buy these assets that are paying you with cash flow, well, now after a decade of sacrifice, you are going to be able to reap the rewards of that, which is now you're going to finally have a solid stream of cash flow. So if you want to go through this decade of sacrifice, which is not easy, I mean, it's the reason why the majority of people will never become financially successful or wealthy. The majority of people do not want to make this financial sacrifice of you working to live smaller and earn more money, not so you can drive a BMW, not so you can buy all the fancy Gucci, not so you can have a big home, but so you can have more assets. And if you put in that work to own more assets that are paying you with cash flow, now you got the checks coming in every month, every quarter, every year, And now you have this money coming in without you physically working, because remember, you got to work here to get this check. You don't got to work here to get this check. This asset cash flow is coming in passively. The only thing you got to do here is make sure that your assets are still good, making sure that you still own a good portfolio of stocks, making sure that your real estate is still good. All you got to do here is monitor it. Here, you got to go into the office or go into work and keep getting that paycheck, because if you don't work, you don't get that paycheck. Here, if you don't work, you still get paid. But in order to get paid here, you got to keep contributing money here week after week, month after month, year after year for at least a solid decade. And if you do that, now you're going to have a brand new stream of income that can allow you to drive that nice car without worrying about the price. You have the money coming in here that will allow you to go on those vacations and not have to worry about the price. You got the money coming in here to buy the fancy clothes, and you don't got to worry about paying for it, because it's your assets that are paying for it. It's not what you are working to pay for. This is how wealthy people really become wealthy, because if you can build this type of cash flow, well, now you have true financial freedom, because now you have assets that are paying for your lifestyle instead of just you working to pay for your lifestyle. This is what it means to become wealthy, because now it's your assets that will fund your finances. Now the question is, what are these assets that you should be investing in? Now I'm going to go over mainly two types of assets. I'm going to talk about stocks, and I'm going to talk about real estate, because these are probably the two most accessible ways for the average person to generate this type of cash flow. When you go out and you invest in a company in the stock market, what you're doing is you're literally buying a business. If you go out and you buy one share of the Amazon company, you become one of the owners of the Amazon company. If you go out and you buy one share of the Apple company, you become one of the owners of Apple. If you go out and you buy one share of Chipotle, you become one of the owners of Chipotle. If you go out and you buy one share of Sweetgreen, you become one of the owners of Sweetgreen. You get the idea. Now you're literally buying one of the pieces of ownership in that business instead of just buying a product that this business sells. Most people just think about businesses as their products. You go and buy things on Amazon. You buy the newest iPhone. You buy a Chipotle bowl. You buy a Sweetgreen salad. That's how most people are wired to think. When you go out and you invest in a stock, now you're actually buying the business instead of the product. Well, some companies in the stock market, not all of them, but some companies on the stock market pay what's called a dividend. A dividend is a cash payment that you get as an investor for doing nothing except owning the stock. Now again, not every company pays out a dividend. And the reason why is because for a company to pay out this dividend, they have to have a big profit. So now when a company makes a profit at the end of the year, there's three things that they can do with this cash. Number one is they can save this money in case of an emergency. Number two is they can reinvest this money back into the company. Or number three is they can just give it away to you, one of the shareholders, one of the owners. Now, when it comes to saving the money in a company, you got to think from the perspective of a business owner. If a company makes $100 million of profit and they kept $100 million in their bank account, well, that's dead cash sitting there. Not every company wants a ton of dead cash sitting there, because the $100 million isn't generating a return for the company. Companies want to do something with their money, or at least give this money to their owners. And so if a company has a big enough bank account or a big enough savings account, they might not want to save more money, which then brings us to option two, which is reinvest the money back into the company. Now, if it's a smaller startup growth company, you bet they're going to want to invest all of this money, maybe and some more, through debt and other investment money back into the company, because they want to grow bigger. They want to expand their market share. They want to be a larger company. And when a company is trying to grow, they're going to be investing everything that they can to open new stores, open new manufacturing plants, open new research and development facilities. That way they can keep expanding and growing their market share. But when a company becomes even bigger, and now you're a much larger conglomerate, and you don't really see that opportunity to keep investing and growing as quickly, now you might not want to reinvest all this money back into the company, which leaves now this cash back in the bank account. And if you don't want to just save it, well, then you can give this money away to the shareholders, people like you who own a piece of the stock. Now, this is called a dividend. And companies that pay a dividend generally pay out this dividend quarterly, meaning every 3 months. So now, if you buy a stock that's paying a dividend, that means you're going to get a cash payment every 3 months for doing nothing except owning the stock. Now, does this come with risk? Of course. If you invest in a company on its way to bankruptcy, well, eventually they might cut that dividend, or they'll have to cut that dividend. Plus, you could also see the value of that stock fall. And this is where you have to understand how to value an investment and know how to research a good stock. And you might be saying, but Jaspreet, I don't want to do all that. I don't want to keep up with the company. I don't want to research the stock. I don't know how to do that. I don't want to research the financials. That's okay. You don't have to. The alternative to investing into an individual company is to invest in something like a fund, maybe a dividend-paying ETF, a dividend-paying index fund, a dividend-paying mutual fund. Now, instead of investing in one company like, let's just say, Apple, now you can invest into a basket of companies that have, say, 500 different companies in here, and Apple is just one of the companies, and there's 499 other dividend-paying companies in here. So now you can go out and find these dividend-paying funds. Again, you have ETFs, mutual funds, index funds. You go out and find one of these dividend-paying funds that invest in companies that are paying a dividend. Now you invest in one thing that's investing in 500 different companies. Now you can lower your risk, because if Apple were to go bankrupt, well, now you have 499 companies to balance it out. This way you can lower your risk and keep getting those dividends. That way now you can just keep throwing your money into one of these funds. So this is option one. You can invest into an individual company. I am not telling you what to invest in, just giving you an example. You can invest into an individual company that's paying a dividend, or you can invest into a fund that's paying a dividend. But again, the key is you got to just keep reinvesting that money. Option number two is you invest in real estate. Now you're going to go out and buy a property. Maybe it's a house, maybe it's an apartment complex, maybe it's an office building if that's something you're into, maybe it's a retail building, maybe it's a mixed-use building, maybe it's a storage building. You're going out and you're buying this property, but you're not buying it to live in or use yourself. You're buying it to rent out to somebody else. So now you buy this property, you rent it out to somebody else, maybe they'll live in or use this property, and then in exchange for them living in and using your property, they pay you rent. Now the key here is this rent has to be enough to cover your property taxes, your insurance, your maintenance, your management fees, any vacancy costs, and then if you have any debt, cover that as well, and then put some money in your pocket each and every month. That's the right way to invest in real estate. You have some people, especially when you're in a very hot seller's market like we've been seeing, when you're in a very hot seller's market, you will see investors go out who have a lot of cash, just go out and buy properties and say, you know what? I'm okay losing money every single month because I think this property is going to be more valuable next year. So I'll be able to flip it for a profit. That's not the game that I play. That's too risky, that's too speculative, because I have no idea where housing prices or real estate prices are going to be in a year. I don't like to play that game. What I like to do is I want to make sure I can make a profit in my cash flow every single month and just keep working to accumulate the cash flow. I just want to keep stacking the cash flow because now I know, okay, this property is going to make me $250 a month. If this property is going to make me $250 a month, I got to buy a second one for another $250 a month. After 10, I got $2,500 a month coming in profit. After 100, I got $25,000 coming in profit. And now it's a game of just stacking cash flow and how fast can I stack that cash flow. Now again, you don't have to be a real estate investor. You don't have to invest in stocks, but you have to start putting your money to work if you want to start generating the cash flow. There's some people on the internet that say that the only way to build wealth is to invest in real estate. Well, there's a lot of people that have become extremely wealthy without ever touching real estate. You have some people that say you have to go out and invest in the stock market if you want to be wealthy. Well, there are some investors that only invest in real estate that have never touched the stock market that have become extremely wealthy. What you need to do is find the right balance for you. Personally, I invest in stocks and I invest in real estate. It's just something that I'm interested in. You don't have to go out and blindly follow anybody else. You don't want to be a sheep. The idea is for you to go out and build your financial education, learn how to invest, and find the right strategy that works for you, that works for your family, and that works for your financial goals. Because at the end of the day, if you want to invest your money, you just want to make sure you get the best returns. For me, I like cash flow because cash flow is something that I can predict. And when I got the cash flow coming in, well, now I know I can go out and spend my money, at least the cash flow that I'm generating, and not really have to worry about it because even next month, I'm going to get another cash flow check. That's the way that I like to run my finances. So if you want to invest your money, you got to figure out the right strategy for you. And well, this goes over a couple ways that you can invest your money for cash flow. Wealthy people love investing for cash flow. That means you're taking your cash, you're buying an asset, and now this asset is paying you every single month. And if not every single month, at least every single year. There are two different ideas or strategies when it comes to investing your money. One way is investing your money for growth, and the other way is investing your money for cash flow. When you invest your money for growth, what you're trying to do is you're trying to find some sort of asset. Let's just make it simple, and let's assume you're investing in a startup company. company and you're investing in this company because you hope that you invest this $1,000 today and your $1,000 is going to hopefully one day be worth $10,000, but we don't know when that day is going to come and we don't even know if that day is going to come. But when you invest for cash flow, now what you're doing is you invest this $1,000 today, that way you can start getting paid consistently. Now you're getting paid while you wait. Hopefully, your hope is your $1,000 will grow to something bigger, but even if it doesn't, you're getting paid consistently for the cash flow that you're getting monthly or yearly. Now, these don't have to be mutually exclusive. You don't have to be somebody that only invests for cash flow or the person that only invests for growth. You can do both. You can have some investments that pay you with growth, some investments that pay you with cash flow, but you have to understand your goal when it comes to investing in money. That way, when you make an investment, you got to know, am I looking for growth or am I looking for cash flow? I like investing in both because they both provide different values and they pay you in different ways. I like investing for growth because it gives me more upside potential. I like investing for cash flow because now I can start stacking my cash flow. If I can start buying assets that pay me $100 a month each, now all I'm trying to do is play the stacking game. How many of these assets can I stack up that are each paying me $100 every single month? At that point, it just becomes a numbers game. How much income am I looking for? If my expenses are $3,000 a month and I know that each asset that I buy can pay me $100 a month in positive cash flow, that means I just need 30 of these assets. I need to own 30 of these investments that are now going to pay me $100 of profit every single month. And then if I can hit that, now I'm financially free because I have enough assets paying for my expenses because I got the cash flow. And if you do this the right way, not only are you going to be seeing this cash flow, but you're going to see this cash flow grow, and the asset that's producing the cash flow will also become more valuable because you bought the right asset. The first way that wealthy people invest for cash flow is by investing in cash flow producing businesses. So I like investing in startups. That's one of the things that I like to do just because I'm an entrepreneur. But one of the downsides of investing with startups is that you don't get paid unless the startup really succeeds and they get acquired, meaning they get bought out, or they go IPO, meaning they go public on the stock market. Now, the nice part about that is if the company you invest in does reach that, you can see very big returns. But it also comes with a lot of risk because most of the companies that you invest in will go completely bust. They're going to go to zero. So you don't get paid while you wait. You invest and then you hope and hope and hope and hope that they become something bigger. That way that you can actually, hopefully one day get a payday. When you invest in a business for cash flow, you're doing something completely different. Now what you're doing is you're looking for a company that's profitable and you're going to now come and buy the assets. You're going to be the owner of the company. That way you can get your share of the profit as opposed to being just a worker in the company. You're going to buy the company. That way you can get the profits, and this profit is now your cash flow. Let's assume for the purposes of this example that I own a company that sells markers for whiteboards. And this company does $100,000 a year. And out of this $100,000, $70,000 are my expenses. So a portion of these expenses, so this is all my $70,000 worth of expenses. A portion of these expenses are going to be my costs of goods, COGS, cost of goods sold. So this is the money you have to pay for the plastic and for the ink and all of that. Part of this money is for my packaging. And let's assume that part of this money is for salary. So maybe there's an employee, it may be a part-time person that helps kind of run the business. So I have to pay $70,000 a year to run the business, and then this is my profit. So all of the expenses to run the company are $70,000, and then this leaves an extra $30,000 a year in my bank account. This is the profit. The person who gets this profit is the owner of the company. Now, in this case, I'm the owner of the company, so I get to keep this $30,000. And I can decide either I'm going to take this $30,000 and reinvest it back into the company, that way we can grow bigger, or I can take this $30,000 and go buy myself a new car. It's my choice. But now, what I'm trying to do is I might want to sell this company because maybe I own the company and I don't want to continue working to help grow the company. I don't want to have to keep dealing with the headache and the risk of being in this business, and I just want to get out. I don't want to keep making this $30,000 a year on profit. Sure, maybe I get the salary. Maybe I don't even work in the company. Maybe I've hired somebody to work here, and so this business is completely hands-off. Now, what I can do is I can sell you this company. Maybe I'll sell it for, let's say, 5 times earnings. So I'm going to sell it for 5x profit, which means I will sell you this company for $150,000. Now, what you do you pay me $150,000, you get this company, and now you are entitled to these profits. Again, you don't have to work here. You have other people running the business. You have other people handling this. All you're doing is you're entitled to this extra cash at the end of the year. Now, what you want to do, if you really want to do this the right way, is you want to come and buy this company that you don't have to physically work in. You don't want to buy a company that you have to work to get your payment, because now you're an employee, you're not the owner. You're trying to buy the cash flow. You're not trying to buy another job. So you want to buy this company. That way you can be entitled to this cash flow. But what you want to do is come up with ways to grow the cash flow. So ideally, this is in an industry which you're aware of, that you understand, that you can come and add some value. So if you're in the fitness space and you find a gym that you can add some value, now what you can do is come in and add your new workouts, you can add your new machines, you can add your new marketing, whatever you can do. That way you can increase the value of your company. That way you can increase the cash flow. The key for this to work is you want to make sure that you're buying businesses that you don't have to physically work in yourself. You want it to be a hands-off business. There's a lot of different businesses out there that allow you to do that, but you want to make sure that you're finding a business, if you're trying to get this type of cash flow, that you're buying a business that produces cash flow that doesn't need you to physically work there. Sure, maybe you got to manage the business, or you can hire somebody to manage it for you, but you want to make sure you're just buying a business that you don't have to physically work in, because you don't want to be the employee, you want to be the owner. There's a lot of different ways to do this. You can look for franchises. That way they're already established companies, and maybe you got to work to get it set up. But after that, it can be hands-off depending on what the franchise is. You can buy out an existing company that's for sale. This might be an independent company, not a franchise. You have these type of companies in every single industry. Or you can consider starting your own company, but that takes a lot of work. That is the most work to get started, but you also have the most potential upside and the most risk. If you want to start your own business, you have to have the entrepreneurial mindset. There's a whole bunch of crap on the internet of people selling this idea that you can start a business with very little work, with very little capital, with no effort, and you'll be able to scale your business to 6 figures a year by following the secret system. Well, if that secret system really existed, then everybody would be doing it, and it wouldn't be so dang hard to start a business. That being said, if you do have the entrepreneurial mindset, it is much more accessible to start a business nowadays than ever before, thanks to the internet, because now you can start a business with pretty much no money. I mean, you can start a blog, you can start a YouTube channel, you can start a podcast, and all these things can now funnel leads and revenue into your business, which then you can reinvest to create your own product. Like Minority Mindset started off as a social media page. It started off as an Instagram page. Then eventually I started a YouTube channel. I didn't buy any fancy equipment. I just started making videos off of my iPhone. I mean, I didn't have anything. I was recording in front of my white wall. I bought a $20 or $25 tripod. I bought a $25 light, and that was it. I didn't have a microphone. I didn't have a fancy camera. I didn't have fancy editing equipment. It was like less than $100 worth of equipment, and I just started making videos talking about the things that were important to me and talking about the things that I wish that I would have learned when I was getting started. Then Minority Mindset started to grow as a YouTube channel, and I had to make a decision. Is this something that I wanted to pursue, or should I continue pursuing my other business ventures? Well, I really liked the whole idea of spreading this type of financial education, so I dove deeper into it, and now Minority Mindset has grown from just one YouTube channel to one of the fastest growing financial media and education companies on the internet. It all started with just making videos off of my iPhone, but it grew into something a whole lot bigger. So you have so many opportunities to start a business if you have the entrepreneurial mindset and the entrepreneurial bug, and you're willing to work your butt off. But if you're not willing to do that, then don't try to start your own business, but you can buy a business where you can try to see where you can increase the value. But again, in order for this to work, you have to make sure that you're doing it in a hands-off way. Now, if you don't have access to a lot of capital, you don't have access to a lot of cash, this is going to be harder to do because you're trying to buy somebody's cash flows. You're trying to buy somebody's profits, and you can pretty much estimate that you're going to be paying somewhere between 2 and 10 times profits depending on what the industry is. So if a company is making $10,000 a year in profit, you can expect to pay at least $10,000 to $15,000, if not $20,000 to buy that. And it could potentially be anywhere up to $100,000 depending on what the upside is, depending on what the industry is. Every industry, every sector, every type of company, every stage of company is going to have a different multiple. So I can't really just give you one size fits all, but you have to understand, if you're trying to buy somebody's cash flow, you need some cash in order to do that. Now, if you don't have any cash, then it's going to be harder for you to do this without actually working there. But there are other ways. I mean, there are creative ways for you to go out and buy a business by having the seller finance the business for you, and then you might have to physically work there to help grow the company, and then you can eventually hire yourself out, hire somebody to take your spot, and then if you can build the company even bigger, now you can own the cash flows. So it's a way for you to get started without investing a whole bunch of cash yourself, but it takes more work, and you got to be more creative. and you're going to need, again, the entrepreneurial bug. The alternative to doing all of this is just by finding a company on the stock market, a publicly traded company that's paying out a dividend, and now you just invest your money into this dividend paying company because now this company is already profitable. That's why they're paying a dividend. And now what you're doing is you're buying the company, ideally because you believe in the future of the company, but in addition to that, they're paying you a dividend, so you get paid while you wait. So maybe you go out and you find a company like McDonald's, and you're like, okay, McDonald's has a lot of upside. I like McDonald's. I'm not telling you to invest in McDonald's, just an example. And McDonald's pays a dividend. So because I believe in the future of McDonald's, I want to invest in McDonald's, but they're going to pay me while I wait. So you buy shares of McDonald's, and every 3 months, every quarter, they're going to pay you a dividend just for owning their company. Now, the advantage of investing into a dividend paying company like this is it's completely hands off, because now you don't got to do any work. All you got to do is find the right company to invest in, and then you buy it, and then you let McDonald's and the employees and the executives do all the work. And if they do a good job, well, then you will continue getting your dividends. The risk now is if they screw it up, you're not going to get any dividends because they can drive the company into the ground, and the returns that you're going to get with investing in a company on the stock market would be lower than investing into a company like this because, well, this has more potential risk, more potential upside, and now you are in full control here. You own the whole asset, and so you have the ability to get more upside here versus just investing in a dividend-paying company in the stock market, where typically you're going to get somewhere between 2 and 5% a year in dividends. Can you find more? Sure. You have some companies that pay higher dividends, but in general, they're somewhere between 2 to 5% a year. Here, you can get a much better return on your money. If you invest $150,000, you make $30,000 a year in positive cash flow. That would be a 20% return on your money. Now, obviously, yes, this has more risk, which is why you also have more potential upside. So you got to understand where you want to be and how involved you want to be. The second way that wealthy people invest their money for cash flow is by investing your money into rental properties, real estate. Because now what you're doing is you're buying a property, not just to hold on and hope that this property will be worth more at some point in the future. You're buying a property, that way you can rent it out, and now somebody else is going to live in or use a property, and during the time that they're living in or using a property, they're going to pay you rent. So you're getting paid while you wait. See, when most people buy a home, here's what they do. They buy a home like this. It's a beautiful home. They really like it. They live there, and they bought the home for $200,000. And then they hope that one day, when it comes time for them to sell, they'll be able to sell their home for $300,000. Now, we don't know when this day will be, and we also don't know what the economy or the market's going to look like when it comes time for them to sell. Maybe the economy will be booming, and they'll be able to sell it for $300,000. Or maybe it'll be a slowdown in the economy and the real estate market crashed and they can't even get $200,000 for it. We've seen this happen time and time again in the past. Not just the 2008 crash. That wasn't the first time we saw a real estate crash. We've seen real estate crashes happen time and time again. Now, the 2008 crash was obviously an exception, but we see real estate fluctuations. They're cyclical. You see prices go up and down. So when I talk about investing in real estate for cash flow, what I'm talking about is buying a property, not to just live in yourself, but to buy it so you can rent it out to somebody else. That way they can pay you for cash flow. I'm a real estate investor. I don't care what happens to real estate prices. When I look at real estate, the only thing that I care about is how much money do I have to invest in today and how much money am I going to get paid every single month. That's what I'm paying attention to. If real estate prices go up, great. If they go down, oh well. What I'm paying attention to is how much do I have to invest and how much return am I going to get. My goal when I invest in real estate is to get a minimum 7% annual cash on cash return. Now, if you compare this to that business example, this is going to seem a whole lot less because in a business, you might be able to get a 20% cash on cash return. Here, I'm only getting a 7, and you're right. But the advantage here is this can be completely passive. When I buy a good rental property, I'm going to hand over the keys to my property management company. There's a whole bunch of property management companies out there. You give them the keys to your rental property, and now their job is to manage the property and make it completely passive for you. So they're the ones that are finding you tenants. They're the ones that will have to fix the toilet when it breaks at midnight. They're the ones that have to pay the bills. They're the ones that make sure that everything is running smoothly with the rental property. And then every month, they're just going to send you a report with their check with the profits. And so what I'm trying to do is I'm just trying to get this 7% return consistently. So I'm looking at how much money do I have to invest, how much am I making every single month, and if it adds up to 7%, then this is something I'm going to consider. Now, I'm also looking at what is the area. The location is important. Are businesses flowing into the area? Is there population growth in the area? Is there growing demand to be in this area? I don't want to invest my money into a place where everybody's trying to move out of, where businesses are trying to move out of, where crime is increasing, where people don't want to be. because in 5 years, it's probably going to be worse now than it is then. That's why I spend the time to research the locations. I want to know exactly where I'm investing, and I want to know the neighborhood. I want to know what kind of area it is. I want to know, are businesses moving in, what businesses are moving in, and are people trying to move into this area? Because real estate is a long-term game. It's not something you invest in for 6 months. You invest in real estate for years. And so I want to see areas with growth. And if you see an area with growth, then guess what? Sure, maybe this property will rent out for $2,000 a month this year, but in 5 years, maybe somebody will be willing to pay $3,000 a month because now they really want to be in this home because they love the area. The demand for this area has gone up, so they want to be there. That's why the location is so important, not just so you can see there's upside because the demand has increased, but so you can get better cash flows because now people want to live there. I can't emphasize how important this is because you can change everything about a real estate property. You can change the windows, you can change the door, you can renovate the property, you can add in a better bathroom, you can change the landscaping. But the one thing that you cannot change is the location. And so if you buy a property in a crappy location where the location is getting worse and worse, you can do everything to renovate the property. You can put in $100,000 to make it look nicer. But if it's in an area where nobody wants to be, you're not going to be able to get good rents to justify the property. But if you own a property in an area that's growing, that's a place that people want to be, well, now not only are you not going to have a hard time finding tenants, but you're also going to be able to charge better rates for your tenants because now people want to live there. And if more people want to live there, well, then that means you can charge more money on your rents, which means over the years, you will see your cash flow go up. Now, a little warning there. What I don't want you to do is invest into a property based off of future cash flows. You see this happen all the time, where people will offer you an apartment complex and they'll say, okay, buy this property for $1 million today and it's going to be a 3% return this year, but in 2 years, you will start getting the 7% returns, assuming that you can increase rents by 10% a year. I don't like to make those assumptions. That's speculating. I don't like to buy based off of future possible rent growths because there's a chance that will not happen. There's a chance we could see an economic slowdown. Is it possible? Yeah, I don't know how possible it is, but it is possible. So when I make my investments, I want to make my investments based off of today's prices and today's rents because what I want to do is I want to make sure I have a cushion. In case things slow down, I want to make sure I'm always protected. And so if things do slow down and I have to cut the rents, I want to make sure that I'm protected and that I'm not having to go into my pocket to cover the expenses of the property. So when you do these type of real estate investment decisions, you want to make sure you're smart and you want to make sure that there's enough profit there with enough cushion to cover the expenses and a potential slowdown. And the third way that wealthy people invest their cash flow is by turning their cash into an asset. So watch this. When you take your cash and you put it in your hand, this cash is a liability because every single day the value of your dollar is dropping because of inflation. As the money supply goes up, the value of your dollar goes down, and as buying power goes down. So when you take this cash and you invest it into the bank, what you're doing is you are investing a liability. So your cash sits in the bank, it's a liability because your money doesn't grow. It just sits there. It's dead. But at the same time, the price of everything around you keeps going up because that's what inflation is doing. It's diluting your buying power, which is making the price of things go up. This is why your rent keeps getting more expensive. This is why your groceries keep getting more expensive. This is why your vacations keep getting more expensive. As the value of your dollar goes down, the price of things go up. So when you keep this money in the bank, your cash isn't growing. It's just sitting there. But when your bank gets this deposit, they take it and they turn it into an asset. So this cash is a liability for you, but it turns into an asset for the bank because what the bank does is they're going to turn around and they're going to lend your money to this person with a very nice mustache over here, and they're going to say, hey, how about you take your liability? So they're taking your liability. This is you. I'm going to draw you a braid for our female followers, or as we like to call it in my native language, Punjabi, a gut. You deposit this cash into your bank. This is a liability. The bank turns around, turns your cash into an asset by lending it to the person with a mustache. And now this person with a mustache is going to say, hey, I got this cash. I can go and spend it somewhere. So this person with a mustache is going to go buy some nice guacamole. But what they have to do also is they got to pay the bank back interest. And so this is how the bank can turn your liability into an asset because they're lending your asset out and they're getting paid with interest, and this interest is more than 0%. If you've ever borrowed money from the bank, whether it's in the form of a mortgage or the form of a car loan or the form of a credit card debt, you're not paying 0%, but they're paying you 0%. So the bank gets to take your money for free and then lend it out. They make 4 to 20% a year in interest and they pay you nothing. And so what you want to do is you want to try to be the bank. Take your cash and turn it into an asset by lending it out to somebody else. See, when the bank lends you money in the form of a credit card and you spend this $100 that you don't have, you have to pay this $100 back plus interest, but the bank doesn't have to do any work to get this money. They're letting you go work, you're working a job, that way you can pay this money back plus interest. So it's a cash flow producing business for the bank because they're just lending money out and they're getting paid with cash flow. This interest plus their principal back. Now, is there risk associated with this? Absolutely. There's a chance that this person with a mustache is going to default and they can't pay all their money back for all this guacamole that they were eating. And so they factor in that risk through the higher interest rates. So this is something that you can do, but you have to understand the risks. There are tons of platforms on the internet that will allow you to lend money to somebody else. Either it's lending money to somebody else, that way they can just borrow it to do whatever, or you're lending money to somebody else, that way they can borrow your money to go out and buy real estate or buy some sort of hard asset, and then this asset is collateral for the money that they're borrowing. Again, just like everything else, it has its own fair share of risk because now this person can default, they might not pay their money back, but if you have some sort of collateral like real estate attached to it, then you can foreclose on this property in case they don't pay you back. But this is something that you can take a look at, lending your money out, because now you're taking your cash, which is a liability, and turning it into an asset, which is now paying you with cash flow because your cash is going to somebody else, and now they're using your cash, and in exchange for them using your cash, they're going to pay you with interest. Another way that you can do this is through cryptocurrency, which is very popular because you have exchanges which will let you buy something called stable coins. Stable coins, or some of them at least, are pegged to the value of the US dollar. So you have these stable coins where one stable coin is worth $1 and these stable coin companies will hold enough US dollars to cover however many stable coins are bought. So if somebody buys 100 stable coins, the stable coin will buy $100 or they will get $100. So that's the way they work. But the interesting thing about stable coins is you can put these stable coins into something kind of like a money market account. They're not exactly a money market account because they're not banks and they're not FDIC insured, but you take these stable coins that you buy. So you take $100, you buy 100 stable coins, and then you take these stable coins, you put them in one of these interest-bearing accounts, and now these interest-bearing accounts will pay you somewhere between 7, 8, and 9% a year in interest on your stable coins, and then you can convert your stable coins to cash at any time. Now again, this is not completely risk-free because these financial service institutions are not banks, so they're not FDIC insured. And so if the person that the institutions are lending to and all of them default, well, now there's a chance that you wouldn't be able to get your money back. And so you have to be kind of smart when you do this and make sure that you're working with a financial service institution that's reputable, that's lending these cryptocurrencies to people that are also credible. And so you want to make sure that your money is protected. But it's a way for you to now get better interest rates on your money by, instead of just keeping your money in cash, taking your cash, putting it into one of these stable coins, and now these stable coins can generate you interest, which you can convert back to cash at any time. Remember, just like everything else, it's not completely risk-free. There are risks associated with it. Just like how you can invest in a business and it can go bankrupt, there's a chance that something could happen to your stable coin, or something can happen to the financial services institution which is holding onto your stable coins. And so if something happens to the cryptocurrency market, you want to make sure that your stable coins are protected. So you want to make sure that you understand the risks, but it can also generate you great returns. So if your goal is to invest your money and start generating cash flow, the first thing you got to do is understand which asset class you want to invest in, which pays you with cash flow. Then you want to start getting educated and try it out. Dip your toes in the water, that way you can see what it's like. That way you can start stacking your cash flow and build it to a point where now you can start living off of your cash flow. When I used to think of multiple streams of income, in my mind that meant, wow, in my bank account, that means one week I might get a $1,400 check from one place and then a $400 check from somewhere else. And then the next week I might get a $600 check from somewhere and then a $400 check, and then next week a $1,000 check and then a $300 check. The whole idea is you're not just making income from one place anymore, you're making income from 4, 5, 6, 7 different places. So you just quadrupled your income because now you got multiple streams of income coming in. But the reality is it really doesn't work like that. Let me start by talking about the 7 streams of income that millionaires have. This is what every media company on the internet talks about when it comes to millionaires, business and how they are rich is because they have these 7 streams of income. So one is your earned income. This is the money you make from your job. One is your stock dividend income. One is your rental income from your real estate. One is your capital gains income from selling your investments and assets at a profit. One is your interest income. One is your profit income from your businesses. And I am missing one. One is your royalty income. That sounds great. You go to work to get a paycheck, and with your paycheck, you get 6 other paychecks too because you got these multiple streams of income working for you. Here's the thing. If you want to create an income stream, you got to invest one of 2 things. You got to either invest money or you got to invest time. Like if you wanted to start this business and get this business paying you money, either you got to invest your time to build this business and get it going, or you got to have the money to fund the business and have somebody else run the business. That way it can make you some money. If you don't got money, then you got to invest your time. But there's only so much time in a day. Like there's only 24 hours in a day, and there's no way for you to build 7 different businesses or 7 different income streams at once. That means if you want to create multiple different income streams, you got to be investing the money. But if you don't have the money to invest in 7 different income streams, then you're just gonna dilute yourself way too thin and create income from nowhere. The whole idea of multiple streams of income makes sense because now you're not relying on one income. Like if you have this accounting business and you only have one client and this client leaves you, now you have no more money coming in. But if you have 5 different clients or 10 different clients and one leaves you, it's not as big of a deal. Same with your job. I mean, if all of your money is coming in from your job and you have no other streams of income, and then you get fired from your job, now you got no other money coming in. There's a few different strategies or ways to look at multiple streams of income. One way is, okay, I want to become wealthy, and so I'm going to do a whole bunch of different things because hopefully one of these things is going to stick and make me very successful. So I'm going to start this e-commerce business, I'm going to do freelancing, I'm going to do this affiliate marketing, I'm going to do the side hustle, and I'm going to do a bunch of these things, and hopefully one of these is going to make me a millionaire. Number 2 is, okay, I go to work every single day and I make a good paycheck, but then I'm gonna invest some of my paycheck into real estate and stocks and these passive investments. That way now I can create new passive streams of income. And number 3 is I'm gonna put all of my eggs in one basket and I'm gonna work really hard to do this one thing and create this one stream of income really big. And once I do that, then I'm gonna have more money to invest into a whole bunch of other things and create more streams of income. Let me start by talking about number 1 because that's where I used to think when I started my entrepreneurial journey, because I used to think that becoming wealthy was kind of like a ladder. I'll show you what I mean. Here's how I used to look at multiple streams of income. I used to think that multiple streams of income and wealth kind of look like a ladder like this, where each one of these steps was a different type of income that you would create. So one might be your e-commerce store, one might be freelancing, one might be doing affiliate marketing, one might be a side hustle and cutting people's grass, and one might be, I don't know, selling cakes. If you create all these different income streams, this ladder, then eventually you're gonna get to the top, and this is where wealth is sitting. So if you can create multiple different streams of income like every millionaire has, then you will have the income coming in to help you climb up this ladder and reach wealth, because that's where everybody wants to be. We all want to be at the top of the ladder. And so this is exactly what I was doing. I started off over here working at weddings. And then I had the idea with a partner of mine to start this event planning business. This is still in high school. And this event planning business and this wedding business that I was working on carried on into college. So I'm doing these 2 things. And then a friend approaches me with the idea to start this t-shirt business because a bunch of people are buying t-shirts in college and we can make a lot of money selling these t-shirts. So now I got this t-shirt business that I'm also kind of working on in addition to that. And then I'm starting to see people make all this money in the stock market because they're trading stocks, they're trading penny stocks. I have no idea how this works. So now I'm learning about stock market trading and trying to make some money in the stock market. And then I go to this seminar and this guy is talking about this college painting business that we could start, where essentially we could run our own kind of mini business and hire people to paint people's homes and make a lot of money doing that. So I didn't actually do this, but I almost started this college painting business. But now, the way I look at it is I got a bunch of different things going for me. None of them are really making me that much money. My event planning business was doing pretty good, but the other things were not making me that much money. But I have all these things just in case, because if one fails, now I got a backup. I'm just throwing things at the wall and hoping something's gonna stick, because if something sticks, now I will have a huge thing that's gonna make me successful, because now I'm climbing up this wealth ladder because I got these multiple different streams of income, even though most of them are not really making that much money, but they're taking a lot of time out of me. When I was in this stage, anytime somebody would come to me with a business idea or a money-making idea, chances are I was gonna jump on it because I don't wanna miss out on the opportunity to make something or be a part of something that's gonna make it big. And so I'm just kind of spreading myself here, everywhere, because I want my hands in a whole bunch of buckets, because just in case one of these things make it, I want to be a part of that thing. And so now I have my hands and myself tied everywhere, but I'm not really making that much money because I'm spreading myself way too thin. I am very broad. I have no speciality. I'm not narrow at all. I'm just kind of do a little bit of a lot. I'm trying to be a jack of all trades, but I'm not going really anywhere because my ladder is just staying stagnant. This is what most people are talking about and preaching and pitching when they're talking about multiple streams of income. It's having your hands in a whole bunch of different pots and creating a bunch of different things and trying to create these different income streams. That way you have a whole bunch of different incomes coming in. That way, in case one fails, you got something else to fall back on. Now, this didn't work for me. It works for some people, but for the majority of people, for the majority of millionaires out there, this is not the way that most people become successful or wealthy. It doesn't work like this. If you've ever seen the movie Yes Man, that's kind of how I felt when I was living like this, because anytime a business opportunity or a money-making opportunity came my way, I tried to jump on it because I figured if this one works, if it pops, I'll be a part of it and then I'll be on the winning side of it. But when you try to do everything, at least for me, when I try to do everything and I stretch myself so thin, I ended up really doing nothing. I had, one income stream that was doing pretty well, but the others were kind of just there, and there were learning opportunities, which was nice, but they didn't make me any money. The second type of multiple streams of income is how the majority of people become millionaires. This is where you have a job, you make money, and then you invest some of your money into stocks or real estate or other passive investments that are working to make you more money. This is the one that I talk the most about on our YouTube channel because this is the one that's most accessible to people, because if you're working a job, now it's all about living below your means. That way you have some extra cash. Now you can deploy this cash somewhere else. That way this cash can earn you more money. But when you are investing this money, the important thing here is you understand the risks involved and you understand the learning curve. Because if you understand the learning curve and you put in the effort to learn what you're doing, you can get a much better return on your money, because now you are not spreading yourself too thin. Again, because you're not just throwing your money in random places. You're putting your money where you know, and when you know where you're putting your money, you can get a better return on your money. Like I just turned on 2 very potentially lucrative investment opportunities just because I'm not familiar with these investments and I'm not ready to go through that learning curve right now. One was in this transportation company. They were looking for a financing deal. It was like a $50,000 opportunity and they were promising a really good return. And the other was this hotel. They wanted a $100,000 investment and they were building this really nice hotel in a great area. I turned both of these down because I'm not familiar with either of these businesses and I don't want to go through the learning curve right now to learn how these things work. I want to continue investing in things that I know, and when I got some more time, maybe I'll look into investing in other things. I talk about this when it comes to stock market investing a lot, where you have to pick a strategy. For a lot of people, when it comes to stock market investing or just investing in general, their strategy is throw your money into something and hope it makes you some money. But that's not a real strategy, and it doesn't work when things go wrong. When you want a real strategy, you got to know what is your investment criteria, what are you looking for, and then invest based on that, because this strategy is going to help you not just when times are good, but when things go wrong as well. You got to know what you're looking for. You got to know what your expertise is, master that. And if you can do that, you will be able to make way more money over the long term, because now you know why you're investing and you know what you're doing. If you're working a job and you have an income coming in, you should 100% be investing some of your money. Now, when you're starting off as an investor, you're not going to know how to invest. I get that. And so there's a learning curve that you have to go through, but you just got to understand that there is a learning curve. And as you start to learn, that's when you want to go from this broad to narrow understanding of your investments. Where are you investing? Are you just throwing your money into stocks, or are you throwing your money into value stocks? Or what type of investments are you looking for that's going to give you the best return? Because once you start to narrow your focus, you're going to understand way more about how to use your money and understand the investments way better. This is where you got to really understand the difference between an active investment and a passive investment. An active investment is something where you put your time into something to make this money, right? Like I talked about earlier. If you want to create an income stream, you got to either invest your time or your money. So an active investment is something that requires a lot of your time. This is something like your job, because if you want to make money from your job, you got to go into work and you got to do something. That's how you get paid. A passive investment, on the other hand, is just where you throw your money into something and then you can turn around, do something else, and continue to get paid. The thing about passive investing, which is cool, is you get paid without doing a task, but you're going to get a smaller return with your passive investing than your active investing because you're not putting your time in it. It's just your money. When you invest your time and your efforts and your labor, you can get a much better return on your money, but there's a limit to how many active investments that you can do because we only got 24 hours in a day. So you might be able to do one active investment, maybe two, like your job and a side hustle or a job and an evening business that you're working on, but that's really it. You cannot manage 7 different active investments and hope to make it big with all of them. You got to start with one, manage one, grow it, and then continue whenever you're making this money to invest it into these passive investments, things like stocks and real estate. Real estate isn't always passive in the beginning because there's a big learning curve you got to get through and understanding how real estate investing works. But once you get past that hurdle, then real estate can be very passive. This is why as soon as you start making money, as soon as you start getting an income, you want to start putting some of this money towards your passive investments, because this is how most people become wealthy and millionaires, is by taking a little bit of money every single month, every single paycheck, and putting it towards your investments. Every single time you get paid, that way now you're building this little nest egg that is working to make you money. And as you do that, you're going to build this wealth slowly, and you're going to learn along the way. You're going to learn the different types of investments, and you're going to learn how to grow your investments. So you just got to make sure you keep funneling some of your money into these passive investments. And this brings me to the third strategy of multiple streams of income, which is where you build one stream of income first, one massive stream. And once you do that, now you diversify into your 7 streams or whatever you want to have. Do you remember this ladder method that I talked about before? Now let me show you why I'm not a fan of this method anymore. Because let's assume that you have $50,000 and you want to start creating these multiple streams of income. So you already work in a job and you got this extra $50,000 and most of your time is going to your job. Now, one of the things you're going to do is you're going to invest some of this money into the stock market. So you can put $10,000 into the stock market. Then you want to start this business because you want to create this profit income. Well, you're already spending all this time at your job, and now you got to put some money into starting this business. Maybe you put another $10,000 into starting this business, but now you're working a full-time job and starting a full-time business while you're putting some money into your stock market investments. If you really believed in your business, why are you investing in the stock market when you could be funding more money into your business? I mean, the stock market might be able to get you a 5, 6, 7, 8, 9, 10% return a year on your money. But if you can grow your business, you can double your money in a year or 2 years. So now you have a little bit of money going into your business, you have a little bit of money going into your stocks, and then you want to create this royalty income. So you start writing this book. And if you want to write a book, it takes a lot of time, but it also takes money to publish the book and market the book and get it out there. You might put another $10,000 into getting this book out there because you want to create this royalty income. But now, if you really believed in this book, why are you putting so much time and money into this different business? I mean, you could just be pushing this book and create this real royalty income from your book. And now you want to invest in real estate on top of that. And you got a little bit of money left. And now you're going to put this money as a down payment to invest in this rental property. But you don't know any contractors. You don't know any real estate agents. You don't know any real estate attorneys. And so you kind of just going through the deal trying to find this way to create this passive income. But you're spreading yourself too thin. You had $50,000. That's a good amount of money. But you're putting some money here, 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 here. But it's not taking you anywhere because you're not believing in yourself in anything. You're just spreading yourself everywhere, hoping something's gonna stick. But when you do everything, you end up doing nothing. That's why for me now, I look at this multiple streams of income not like a ladder, but more like a wheel. This looks more like a donut than a wheel, but let's assume this is a wheel where now what you wanna create are spokes in this wheel where everything supports the central purpose. And as you kind of develop one of these spokes, it helps build the second spoke and the third spoke. But the important thing here is you want to focus on building just one spoke first. Once you can develop one spoke, once you are worth $1 million, now we can start working on the second spoke, and then the third spoke, and then the fourth spoke. And the important thing here is every time you develop a spoke, this needs to help build this one. These need to all kind of fuel each other. That way now you can create a wheel that keeps spinning and working towards you. I'll show you what I mean by this. If I give Minority Mindset as an example, we started off just as a YouTube channel of me talking in front of a camera. But then slowly we started to grow and we started to make some more money. And then I started reinvesting this money back into Minority Mindset. One of the things that we did was we created a financial newsletter. Now, our financial newsletter kind of supports our YouTube channel, because when you subscribe to our newsletter, then we can support our YouTube channel, and our YouTube channel supports our newsletter. We both talk about financial stuff, so we both educate you in a different way. Our YouTube channel is a lot about financial education. Our newsletter is all about what's happening in the financial world, but it's creating a new stream of income for the company. Then, as the newsletter grew, now we're investing heavily into our blog and our website. We have a dozen or so writers for our blog that are writing a bunch of financial education content to provide you with more valuable content, more financial education, and now each of these things are supporting each other. If you go onto our website and read our blog, well, then you might be interested in checking out our newsletter. And if you check out our website, you might also be interested in our YouTube channel. But all these things are supporting each other, because if you check out our YouTube channel, you might also be interested in our website. And so all these things are supporting each other, all in the financial space. Now, we're working to develop an app, and this is one of those things that's going to come out in 2021, but all these things are supporting each other, where it's all in the financial media space. We're all a part of Minority Mindset, and we're all building each other. Each one of these spokes helps build the next one, and each of them helps the previous one grow even bigger too. And so now it's not these kind of different things where, oh yeah, let me do some affiliate marketing here. Let me do this Shopify store here. Oh yeah, let me do this freelance hustle here. All these things are uncorrelated, unrelated ladder steps. Now it's a wheel where everything is building each other. You're trying to build the central piece. The tough thing about doing this is you stop being so broad and you get narrow. And the issue that I face, and I know a lot of people face when they try to get narrow, is you feel like you're missing out on a lot of opportunity, because now you think, oh, I'm not doing this and I'm not doing that, and I'm missing the opportunity to make money here, and I'm missing the opportunity to grow my business this way. But when you are not so broad, then you have the opportunity to really focus and make money in a specific niche. And now you're focusing and you can really be the master at one thing. Now, when you can really master one thing, then you can go out and start to get bigger and bigger, because you've already mastered one thing and you've built one spoke. But when you're so broad and so general and you try to do so many different things, you end up going nowhere and nobody knows you for anything. You're just there. But you got to focus on one thing, build this one thing, and then once you are worth $1 million doing one thing, now you can really start diversifying and using your money as a tool, because now you have the money to do it, and you can use your money to help fund these new things, these new streams of income, because now you have the capital to do that, and you have the one thing to help support these other things. And now as you grow, maybe you want to diversify and put your money somewhere else. Now you have the capital to do that, because you have built something, and now you have more money, and now instead of you investing your time to build something else, you have the capital to go and invest in something completely different, learn how to do it, and use your money as a tool to help grow it. Yeah, maybe you're not going to get the same return as if you were the person doing it, but you only got 24 hours in a day, and your money can go way further than you can. You can scale the amount of money you have, but you cannot scale your hours. And so now when you got this going, now it's all about taking your money and putting it to places where you want to go. Yeah, maybe you built this thing here, now you can invest in commercial real estate here, or maybe you want to invest in hotels, or maybe you want to invest in startups. You can kind of figure out where you want to go and specialize in that, but now you got the capital to help take you there. So when it comes to multiple streams of income are great, but you got to understand how multiple streams of income really works. If you want to create these multiple streams of income so you can become successful or wealthy or rich, chances are you are spreading yourself way too thin if you're trying to do 7 different things at one time. What you want to do first is find one thing, master that, be the best at that, and build that first. Once you can do that, now it's a lot easier for you to kind of go out and be a little bit broader now, because you already started narrow. You have built this one thing, you have created this one stream of income, and now you can start putting this money somewhere else. Now you can start investing your money into other passive investments, maybe other active investments, because now you have the capital to help you do that. But it all starts with that one stream of income first. You got to build this one thing, and once you are the master of that, then you can start spreading it out. If you've ever read Made in America by Sam Walton was the founder of Walmart, he talks about this very concept. He says that one of the reasons Walmart became Walmart, one of the biggest retailers in the world, was because he didn't diversify. He kept growing Walmart, and he kept his eggs all in that one basket, because his most important thing was to build Walmart before he started creating these different streams of income. He wanted to build one thing first, and then Then was the only time I started thinking about doing other things. If you want to be an overpaid employee, there are 3 things that you have to understand. Number 1 is you have to understand the company's financials. Number 2, you have to know how to make yourself irreplaceable as an employee. And then number 3 is you got to know how to get your piece of the pie, meaning how do you get that overpaid salary now? Now, I have hired and fired multiple people at my